UK dividend investing is rubbish. If dividends are so great, then why does the stock price drop the moment you get one? Exactly. Stay with growth stocks. If you are a UK dividend investor, there is a very good chance that you've heard something like this thrown around online. The real question is, what's the real truth behind dividend investing? Is it really true that growth stocks are always better than dividend stocks? Well, today we are cutting through the hype so that we can see together what dividend investing is and what it isn't. We'll cover the mechanics of the dividend snowball versus true math. I'll also show you how much capital you realistically need to hit 500, 1,000 or even 2,000 pounds a month in dividend income. Before we begin, as always, this is not financial advice, so please don't take it as such, and always do your own research before investing. All right, let's dive in. Let's start by clearing something up that's often misunderstood about dividend investing. Dividends are not free money falling off from the sky. It does not discredit the value or convenience of dividend investing in some cases, but it's just a point that's worth understanding. When you own shares in a company, dividends are simply paid out of the profits of the company that you already own. I know this might sound obvious, but trust me, there are many people out there who are still not clear about this point. And because dividends are paid out of the company, the market usually adjusts the share price when the dividend is announced. And here's an example to make it crystal clear. Let's use Tesco, for example, as our hypothetical stock. Imagine Tesco share priced up £100. And let's say they decide to pay a dividend with a 5% yield, which would be £5 per share. On the ex-dividend date, and I'll explain what an ex-dividend date means in a minute, the share price typically drops by about the dividend amount. So in this case, Tesco share price would fall from £100 to £95. Now let me quickly clarify what an ex-dividend date is. If Tesco announced a dividend that would be paid out on, let's say, the 1st of December, for example, they would also set out a deadline for which investors would qualify to receive that dividend. And let's say that deadline is the 1st of November. If you buy Tesco shares on or before the 1st of November, then you will receive a £5 dividend on the 1st of December. But if you buy Tesco shares on the 2nd of November or after, then you would have missed the cutoff, meaning you won't get the December dividend. You will have to wait until the next cycle. That 2nd of November cutoff is what's called the ex-dividend date. So going back to our example, on the 2nd of November, the ex-dividend date, Tesco's share price will usually drop from £100 to £95, reflecting the dividend that was paid out, the dividend of £5. Hopefully this made sense, and if there's anything unclear about this explanation, just leave it in the comments and I will do my absolute best to get back to you and clarify it. Okay? Now, here's the thing. It actually doesn't really matter whether you buy the stock before or after the ex-dividend date. And here's why. If you buy before the ex-dividend date, you'll pay the higher stock price, say 100, and then you'll get the £5 dividend. But as we saw, the share price will actually drop to £95 after that date. So you basically end up with £95 plus the £5 dividend, which is £100. Now, if you buy after the ex-dividend date, you simply would have saved yourself £5 and got the stock at a cheaper price of £95 with no dividend. So in other words, you get the same net result. You're not better or worse either way. The only difference is whether you'd rather receive that cash flow up front. And on that point, this is one of the most powerful things about dividend investing. Freedom of choice. You, my friend, as the shareholder, gets to decide what you want to do with your slice of profits. You have the choice to reinvest it in the business and buy more shares, or you get to take it out and enjoy it for yourself. Not to mention another extremely appealing reason why people go for dividend investing, which is having predictable, regular payments. And most human beings on the planet love certainty. However, it's not all nice and shiny. There are caveats, and I have a section later on in this video where we talk about strategy and which is better for you, dividend stocks or growth stocks. But first, we need to tackle some of the most common myths and beliefs that you've probably heard about dividend investing. And the first myth is dividend companies can't grow. It's commonly believed that if a company is paying dividends, it must be boring, slow-moving business with no growth left. Now, yes, you're not going to get an Amazon-style hypergrowth from Tesco or Unilever, but it doesn't mean that dividend payers can't deliver great returns. Because what a lot of them actually do is quietly compound wealth in the background by combining steady profits, sensible reinvestment, and growing a dividend stream. Take AstraZeneca, for example. It's one of the largest companies in the UK, and while it's paying dividends, it's also reinvested heavily in research and development over the years. And doing that has helped them grow into a large pharmaceutical leader with steady profits. Unilever is another classic example. They sell everyday products that people keep buying year over year and reward shareholders with both dividends and long-term growth. So dividend players are not dead money. They just grow in a different, steadier way. Myth number 2 is you don't need dividends, you can just sell stocks. This one is technically true. You can sell shares whenever you like to create an income. But here's the catch. That income is now dependent entirely on what the share price is the moment you sell. Imagine if you needed the money in the middle of a market turndown. If the FTSE 100, for example, is down by 20%, you'd have to sell more shares to raise the same cash. And that basically locks your losses at the worst possible time. However, with dividends, you don't face the same problem. The cash flow comes in regardless of the daily share price move. And that makes planning so much easier. And there are many examples of companies that kept the dividend cash flow flowing despite market turndowns. Just a quick side note, I'm thinking of creating a community for UK investors who are serious about investing and financial freedom. A place where you can ask questions, share your experiences, and perhaps share your portfolio with others and get feedback. In this community, I'm also considering doing live workshops where we can all get together, have a cup of tea, and just chat about investing and other personal finance topics. So if that sounds interesting and useful to you, then there is a waiting list that you can join by either scanning the QR code on screen or by clicking the link in the description and in the first comment. And that way, you'll be the first to know when the community goes live. Right, moving on. This one catches a lot of beginners out. You'll see a stock with a 9 or 10% dividend yield and think to yourself, wow, that's amazing. I get paid loads just for holding it. But here's the reality. When the dividend is that high, it usually means that the market doesn't trust that dividend. Either profits are falling or the business model is under pressure. And sooner or later, the payout often gets cut. Now, obviously this isn't always the case, so it's always a good idea to dig deeper into the company financials to understand if the high dividend yield is generally a good deal or whether it's a cover-up for something fishy. And we've seen this happen plenty of times here in the UK. Take Vodafone, for example. Their dividend yield looks attractive for years, but in 2019 they cut it for the first time in 2 decades because simply the business couldn't sustain it. The share price fell and everyone who was chasing yield ended up with less income and less capital. Generally speaking, a sensible range of dividend is usually between 3 and 5%. Enough to be meaningful, but also low enough for the company to reinvest into the business and keep paying over time. Now, let's talk about this idea that we keep hearing online, the famous dividend snowball. The story goes like this. You buy dividend-paying stocks, you reinvest every dividend, and over time the share count grows and the income keeps rolling. Sounds amazing, doesn't it? Like free money snowballing downhill, it just keeps getting bigger and bigger. But here's the reality that people ignore. It takes some serious capital and immense patience to get to the point where you can generate a large enough dividend income to sustain a somewhat semi-decent lifestyle. So let's have a look at some examples with numbers. Say your goal is £500 in monthly dividend income, which is £6,000 per year. At 3% yield, you'd need about £200,000 in invested capital. At 4%, you'd need about £150,000, and at 5%, you'd need £120,000. Now let's double it. Let's say you want £1,000 per month in dividend income, which is £12,000 per year. At 3% yield, you'd need about £400,000 in invested capital. At 4%, you'd need £300,000. And at 5%, you'd need £240,000. And if your dream is a proper live-off dividend income, say £2,000 per month, which is £24,000 per year, then in this case, at 3% yield, you'd need £800,000. At 4%, you'd need £600,000. And at 5% yield, you'd need £480,000. And then there's something that makes this even worse: inflation. If your target is £2,000 in today's money, in 20 or 30 years from now, you might actually need closer to £3,000 or £4,000. And this is just to keep the same lifestyle, assuming that inflation stays at around 3% per year. So yeah, dividend income is definitely possible, but the point here is that meaningful income requires meaningful capital and time. It's not an overnight thing, despite what's circulating around online about this topic. So let's get practical here. If you are a UK investor thinking about dividend stocks, the first question to ask yourself is, what is your actual goal? Because here's the thing, if you're just going to reinvest the dividend back into the same company, then you are basically following a growth strategy anyways. And in that case, you're often better off focusing on growth stocks or growth index funds. Because dividends introduce two disadvantages. The first one is that dividends are taxed. And the second is that the company is paying out cash that could have been reinvested for higher growth. Now, as I said earlier, this doesn't mean that dividend stocks won't grow. It just means that you won't get a higher rate of growth even if you are reinvesting the dividends the same way as you would with a proper growth stock or ETF. And the tax point is a big one in the UK. The dividend allowance has been shrinking faster than the speed of light in recent years. And right now, the dividend allowance is just £500, after which dividend income becomes liable for tax. And if you're earning £50,000 or more from all your income sources combined, then you're looking at 33% of additional rate taxes on dividend income. Now, of course, you can definitely avoid this by using a stocks and shares ISA where your dividends and capital gains are completely tax-free. But if you've maxed your ISA allowance and you're looking to invest more in the general account, then just be wary of what tax bill you might incur. And just to add to this point, a stocks and shares ISA will protect you from tax, but it will not protect you from the second disadvantage of dividend investing, which is the lost potential of more growth in your early years of building your portfolio. And so on that point, let's now talk about strategy. If you've still got 15 to 30 years ahead of you before you need the income, then a growth-focused strategy usually makes more sense. Historically, if we look at broad or US growth index funds compared with dividend-focused ETFs, the growth funds, as expected, have outperformed in the long term. And this is especially true for periods of low interest rates, which favored companies reinvesting heavily into expansion. And here in the UK, if we compare the FTSE 100, which has a major tilt towards dividend payers like oil and major banks, against more obvious growth indices like the S&P 500, the difference is very obvious. Over the last decade, the S&P 500 has massively outperformed, while the FTSE index has delivered steady dividend but very sluggish price growth. So what does that mean for you? If you're still in the accumulation stage, i.e. building capital for the future, then growth investing is usually the smarter play because you're maxing out the compounding effect, you're keeping taxes lower if you're outside an ISA, and you're giving yourself a bigger chance to grow your wealth. Later on, when you're actually close to the point when you want to live off your portfolio, then switching to dividend-paying stocks or dividend ETFs makes sense. At that stage, the focus shifts from growth to income stability, and a stream of dividends hitting your account every quarter makes planning so much easier and reduces the stress of having to sell your shares in a market downturn. And here's the thing that people often miss. It's not about whether growth beats dividends or vice versa. Different styles lead in different environments. Growth stocks do best when money is cheap, whereas dividend payers can hold up better during inflationary and volatile times. So the one thing that actually matters is your behavior. Can you stick to the plan when the market gets ugly? As a quick reminder, this is probably the sort of stuff that we'll be talking about inside the UK investors community that I'm planning to launch. So if you are interested and want to be part of this community, then you can join the waiting list by either scanning the QR code on screen or by clicking the link in the description or the first comment below. Thank you for listening and see you later, my friend.